Welcome back, everyone, to another episode of Living Your Greatness. This is your host, Ben Mummy, and the goal of my show is really simple: to learn from those who have mastered their craft at what they do. So if you are new to my show, please make sure to hit that subscribe button. Today, we have a new guest to the show, and his name is Adrian Day. He is the money manager and president of Adrian Day Asset Management. He has made a name for himself searching for unusual opportunities around the world. So without further ado, Adrian, welcome to the show.
Well, thank you very much for asking me. This should be fun.
Yeah, no problem, Adrian. So Adrian, let's kind of get kicking here. I'm really curious to find out what led you to study economics and eventually pursue a career in finance that then led to you becoming a money manager.
I guess my route to managing money is a little bit different from a lot of people in that I didn't get an MBA or anything like that. I didn't join a big investment brokerage firm and then decide to branch out. I went to the London School of Economics. I've always been interested in history, so economic history is very important to me. And I guess there's a sort of progression with economic history. I was very interested in the gold standard. My very first investments as a young teenager were gold coins. My first jobs were actually writing about economics and economic policy, actually, for conservative organizations in London. So I was writing on economic policy. And then, from there, you start thinking about investments. It's a natural progression. And then I got a job editing a investment newsletter, started making investment recommendations, learning from some of the people, at that particular company who were experienced, including Doug Casey, you probably know or know of. And then, what happened was, after I had this newsletter, what would happen very, very often, people would say to me, well, do you manage money? I'd like you to manage money. And it would be a matter of someone saying, gosh, I saw when you said to sell it, but I was on a business trip and I missed it. So wouldn't it be easier if you did this for me? I get a lot of that. And I'd also get a lot, frankly, of let's just say I recommended a stock at, I'll just make it up. I recommended a stock at $1, said, don't pay more than $1.25. And 3 months later, it was $2. I say, sell at $2, And 6 months later, someone would say, what do you think about whatever, Ajax? And I'd say, well, gosh, we sold that months ago, didn't you see? Well, yeah, but I liked it, and I thought, I'll just see if it goes up anymore. I say, well, gosh, it's back to $1 now, but at least you can get out for what you paid for it. Oh, well, actually, I paid $2 because I didn't read your newsletter until, blah, blah, blah. Anyway, you get the point. And so I just decided, well, maybe, frankly, I thought maybe I can help these people who are taking my advice, good and bad. I'm not saying my advice is always good, but they're taking my advice and they're managing to clutch defeat from the jaws of victory. So at least if I'm doing it, I'll buy what I want when I want, and I'll sell what I want when I want. And there won't be any of these, as it were, excuses. So that's how I started. I just started my own firm. And obviously there was, I think by that time I knew sufficient about the macroeconomics. I knew quite a bit about specific sectors. I knew quite a bit about how to buy stocks and trading and so on. But the learning experience in building a firm, with all the compliance and the SEC registration and, what software to use and all that kind of stuff, that was quite a learning experience, yeah.
What were the lessons that you learned from Doug Casey? You mentioned his name. And were there any other mentors too, besides him, that you really admire, whether they were someone that you knew or someone that you maybe didn't know, but you followed their work closely?
Yeah. Well, I didn't say I admired Doug. That's a joke. So at this newsletter that was called Personal Finance, we had Personal Finance used to have outsiders write articles, and then we would look at the articles and discuss them, and often get back to them to say, can you write a bit more about this? Can you write a bit more about that? So Doug Casey was on that committee, and yeah, Doug was astonishing because Doug would always, he'd have this knack for finding what was missing in the narrative. A lot of people who were making recommendations, writing, would write a narrative, but they'd miss what could go wrong. And Doug was very, very good at looking at things that could go wrong. Mark Skousen was on that committee. I don't know if you know Mark Skousen. The publisher was a chap called Bob Kephart. You probably won't know him, but I learned an awful lot from him in different ways. What were the lessons? Oh, and other people that, I mean, I think my mentor would be John Templeton. The person that I most look up to in the investment field would be John Templeton. He, of course, was a very humble person. He was very religious, but he was a very humble person. But he was really a genuine global investor at a time when there really weren't too many global investors in the US. And he started his mutual fund. Well, he started by buying, when the Second World War broke out, he bought $100 worth of every stock on the London Stock Exchange that was trading under whatever it was, $5 a share, $2 a share, whatever it was. And that's how he started out. And he bought them in the middle of the Blitz when, you know, things were looking pretty bad. And obviously came out okay when the war ended. And then he started the Global Mutual Fund, Templeton Mutual Fund, which was a truly global mutual fund. At that time in the US, very, very few investors, and this was true even into the 80s or 90s, frankly, but very few American investors would invest abroad. And if they invested abroad, they saw it as a sort of separate allocation. Let's put 5% or 10% of our assets into foreign stocks. And John Templeton looked at it differently. He was a truly global investor, meaning that he would look at opportunities around the world, and it didn't matter to him whether they were in the US or elsewhere. Obviously, you apply a discount if you're looking at Argentina or Brazil. You apply a discount, but maybe Switzerland deserves a premium over the US, whatever. And the point is that at different times, his fund had as much, people don't know this, his fund had as much as 80% of its assets in the US, but at other times, it had as much as 80% of its assets in Japan, for example. So global investing does not mean, you know, most of it's in the US and some of it is diversified and spread among a bunch of other countries. It means looking for the best opportunities wherever they are. And I've met, well, John Templeton's deceased now, of course, but I met John Templeton several times, had lunch with him a couple of times, learned an awful lot from him. And as I say, not only a great investor, but a gentleman as well. So two things you learn from him. One is how he started, the contrarian, Byron Blood is in the streets. You know, if you're going to make a lot of, and Doug, I also learned this from Doug, if you're going to make a lot of money, you have to be contrarian. You can't make a lot of money, not over the long term, by doing what everyone else is doing. And then the second thing was to be a global investor.
I really appreciate, you know, sharing, you know, that list of mentors and also what they kind of brought to you and like the learnings, you know, that you just spoke about there at the end. Where do you see the smart money going right now with world tensions and economic uncertainties?
Yeah, no, that's a good question. I think, as you know, as most people know, the US market has outperformed global markets for about the last 12 years since the global financial crisis. And it has increasingly outperformed. So the gap between performance and valuation, both of the US market and global markets, is wider now than it has been for most of the last 50 years. Then you take it once, and global markets have done the major developed markets have done reasonably well in the last couple of years, but they just simply haven't caught up with they haven't kept up with the US. And of course, we all know in the US there's these magnificent seven. Well, if you look at the US market now is so large a part of the global markets. It's probably around 75–80% now. And so those magnificent seven actually are 20% of the entire global market capitalization. And so it's a sort of self-reinforcing mechanism. But anyway, to get to your point, I think the next sort of major move will be for the US market to lag global markets, which will catch up. But in particular, I think it's the smaller markets. I don't mean necessarily emerging markets, but smaller markets. And if you look at if you do what I just did with the US and the global, and then look at the global and the small markets, you find that the small markets have lagged significantly over the last 12 years and are much, much, much cheaper than the major developed markets. So I think the next move, if we're looking at, say, a 5-year move, the next move is likely to be for the smaller markets, the emerging markets, to catch up with the developed markets. And they typically move when you have inflation, but also when the dollar starts to weaken. A strong dollar, I mean, there's some markets that benefit from a strong dollar, but typically a weaker dollar and an inflationary environment is positive for these smaller markets. Now, which ones in particular? There's also some larger markets. I think Britain right now is very undervalued compared with the rest of the market, global markets, but also compared with its own history. And you get stocks there that are yielding 5–6%, good quality companies. But I'm not investing in many of the developed markets right now. So we're looking at, I mean, Singapore, for example, is obviously a developed country, but it's a very small market. Singapore would be definitely a place I would be looking at. High quality companies, I don't want to in any way say anything good about regulation, but the regulation there is quality regulation, as opposed to what we seem to get in the United States. So it's a well-established market, good auditors, et cetera, good quality companies, and quite inexpensive. We're buying in Hong Kong. Now, Hong Kong is very undervalued. It's the cheapest it's been since 1997 with the handover to China. It's the cheapest it's been since then. There are reasons for that, of course. I mean, the thing about being a contrarian is you rarely find anything that's cheap and there's nothing wrong with it. There's always a reason things are cheap, right? And there's a reason for people to be concerned about Hong Kong right now with the increasing influence of China in Hong Kong. It's a very big negative for Hong Kong. Hong Kong is simply not the place it was 20 years ago, unfortunately. But the stocks are remarkably cheap. You can find companies there trading at 20% of book value. There are stocks trading at 2 and 3 times earnings multiples. So, I mean, obviously, when you see something like that, you need to look at it very, very carefully to see what is wrong. But there's stocks there that I think on a balance, risk reward, are certainly worth buying. To be honest with you, we're very cautious right now. I mean, we've got some money in Argentina, as a bet, if you like. I hate to use that word when you're investing other people's money, but as a bet on Milei being able to turn a country around. Brazil, there are some things in Brazil that look attractive. Yeah, that's basically it. We're very, very cautious and selective right now.
Makes sense. So if we think about, you had spoken about being a contrarian, and looking for obviously value, but sometimes investors could get, a mixed understanding of a stock that is cheap and a stock that is of value. So how do you explain, the process of finding a value-based stock that is undervalued and is cheap?
No, that's an excellent question. And, one of the lessons I learned, I used to do it before. I hope I don't do it now. But one of the mistakes that I used to make was be what I would call a knee-jerk contrarian. Wow, this stock went down 50%, let's buy it. Well, that obviously is far too simplistic, as you're suggesting. And I can give a few examples if you want. In the mining business, you look at a company. Well, I don't know if you there's a copper gold mine in Panama called Cobre Panama, and without going into all the details, but basically the government forced First Quantum, the mining operator, to shut it down. Right? Obviously, it hurt their stock price. It also hurt the stock price of Franco-Nevada, which had a stream, like a royalty, on that mine. Right? Now, I'm saying this to illustrate, to answer your question as an illustration. So you look at those two cases, and a lot of people I know, when they saw First Quantum drop, oh my gosh, let me just look it up for you. I don't really follow First Quantum, to be honest, very closely. So, but it went down by, it's coming up. Yeah, I mean, it went from $30 to $14 in 2 days. And of course, that $30 was already way down from where it had been, because there were negotiations going on, there were protests in the streets. And then on the day they shut the mine down, it dropped, but it was already way down. I know a lot of people who immediately said, oh, First Quantum, let's buy it, let's buy it, let's buy it. And, I was very, very, very cautious on that, because basically they had a bad balance sheet. And if this mine was suspended for a long period of time, even if eventually it came back under their management, they would lose the cash flow and they would break their covenants and they would have difficulty paying their debt. So that looked to me to be certainly, I would say there was no rush to buy. And the stock went down to $9.65. I said it dropped to 12, it then went 14, and then over the next month it dropped all the way down to $9.65, and it's still only at $12. Now, Franco-Nevada, which lost the stream, and the stream was its largest asset, it represented 19% of their cash flow. So to them, that was very, very significant, right? But first of all, the stock dropped 30% relative to peers. Dropped 30%, which is significant, but the NAV of the mine was only 16% of Franco-Nevada. So the market was discounting more than the value of the mine, number one. Number two, contrary to First Quantum, and I'm not knocking First Quantum, contrary to First Quantum, Franco had $1.2 billion in cash on his balance sheet with no debt. So you knew the company itself was not at risk, even if they lost 100% of this stream. So we bought Franco, but we did not buy First Quantum. So I don't know if that helps to answer the question. So I think balance sheets are very important to me, particularly when things go wrong. A balance sheet is very important. And then what other assets do they have is very important. How much of a company does this represent? That's very important. But I think there is a mistake or a tendency. Sometimes when you see something like that, you want to jump in too early, too quickly. Very, very rarely do you see something drop 20 or 30% and then the next day come back, and never look back. Typically, there's a bottoming phase after something like that.
That's definitely a great example when you think of risk. So my next question is, when you're thinking about investment opportunities, the first thing is obviously to put on devil's advocate and think, okay, what is the risk here? So how do you look at risk as an investor before making any investment decision?
Well, the first thing that I want to emphasize is the risk is different from volatility. And a lot of people think that volatility, in fact, modern portfolio theory talks about volatility as though it's risk. Two totally different concepts, right? So risk is the possibility of a permanent impairment, whereas volatility is just the stuff going up and down. And as Warren Buffett says, I'd rather a lumpy 20% than a flat 10%. So volatility doesn't scare me. Volatility provides you opportunities. It provides you opportunities to add to positions at better prices, to trim positions on rallies, and so on and so forth. But I know but some people can't stand volatility, and we'll come to this later perhaps, but that's critical. But so that's the first thing I look at: risk versus volatility. I mean, you never, of course, you never want to lose 50 or 100% permanently. You never want to just have that kind of loss, however great the reward is. But I mean, everything in investing is looking at the risk versus the reward. You look at what is the potential, and what is the probability of that potential, what is the risk, and what is the probability of that risk. And you weigh them, basically. But again, I mean, I might have something that could lose 100%. And if I've got a 10 or 20% chance of losing 100%, I frankly don't care how big the reward is. That's not a very good risk reward, at least for clients. It might be for me, but it's not for clients. But if I've got I'll just make this up, if I've got a 20% chance of losing 20 or 30% versus a 30 or 40% chance of doubling my money, then that's a risk that's worth taking. But to me, balance sheets are critical, because balance sheets enable a strong balance sheet enables a company to withstand things that go wrong. And things will inevitably go wrong in any business. They always do. However well run the company is, there's always things that come out of the blue that you weren't expecting. And we can certainly give lots of examples of that. So a strong balance sheet enables you to withstand those kind of out of the blue things, and also some diversification. Again, I know we're not talking exclusively mining here, but a mining example. A company, however good it is, however strong the balance sheet, however wonderful the management is, but if it has one mine in one jurisdiction, it's obviously a lot more risky than a company with 5 mines in 5 different jurisdictions, obviously. So diversification is a help as well. But balance sheets are the most important.
I appreciate that answer. I want to now shift this conversation to, the big picture of one of your theses. And I know I've recently heard you speak at VRIC, Vancouver Resource Investment Conference. And at this conference, you were speaking about your conviction for gold to shine in 2024. So Adrian, do you mind just sharing a couple of, points that you think support this thesis, and why, you want to help people be more aware about it?
Yeah, well, first of all, I've said for the last 18 months that gold will move when the Federal Reserve and other central banks start to ease, primarily cut interest rate, but start to ease before they have quashed inflation. That's when gold will really take off. And if you look at the last 20 years, every time the Fed has changed from a hiking and then started easing, gold has moved up. And it's moved further if inflation is still high. So that's the first thing. Now, I think inflation, although it's obviously, as we measure it, has come down a lot in the last 18 months. It's still significantly above the Federal Reserve's target. And I think it's going to be stubborn, and I don't know if you want to talk about it now or later, but there's reason to think that inflation is going to pick up again over the next 6 months. It's clear that the Federal Reserve and some other central banks have pushed back when they expect to start easing, but there's very little doubt in my mind that, there's very little doubt in my mind that we are heading into a recession. That's going to mean higher unemployment, and at some point the Fed is going to have to start to ease. So that's going to be very, very positive for gold. Whether it comes in the next 3 months or in the next 6 months, I don't know, but it's coming at some point. And then the last thing I would say that, gold stocks typically can be very, you have to hold gold stocks a long time before you get the big moves. And the reason we hold gold stocks, of course, is because they have the potential for very sharp moves in the market. When the gold stock sector moves, it doesn't go up 10% over 12 months. It goes up, double and triple. And just to give you examples, from 76 to 80, the gold stock index went up 800%. From 2001 to 2007, the index quintupled. From 2009 to 2011, it quadrupled. 2016, in 9 months, it tripled. So the returns are very dramatic in relatively short periods of time. That's why we hold on to them during these long, flat periods. And I'm talking about the index. I'm talking about the XAU, which is 30 large companies. So if you look at the smaller companies, you've got the potential for much, much more than that. And so those are my basic thesis. So don't worry too much about whether it's 3 months or 6 months or even 9 months. When the returns come, they'll be very, very dramatic.
Absolutely. And I know you have mentioned before, when it comes to the dollar weakening and, an investor thinking about, preserving their wealth, having, gold or even gold stocks in their portfolio. I know that you've mentioned that the majors is a smart place for an investor to consider looking at, because that's usually the first spot for there to be a move. So could you explain a little bit more about that so my listeners get a better understanding?
Sure. Well, first of all, if you want to preserve wealth, you buy gold, not gold stocks, right? Gold stocks are for an investment or for a speculation, there to make your wealth grow. But if you want to preserve wealth, it's gold. What we've seen in the last 18 months is a little bit of an anomaly, because gold has done really very well in the last 18 months. But the gold stocks, of course, have done very poorly. And there's one central reason for that, which is the central banks of the world have been buying gold. And that's been pushing up the price of gold. Typically, though, what you see when the sector starts to move, you might see gold start to move up, but it's always the seniors that lead, because, when an institution, typically institutions will get into a sector before retail. When an institution looks at buying gold, right, they're looking at Newmont or Barrick or Agnico or Franco or Wheaton. They're not looking at Ajax Exploration or Consolidated Moose Pasture, right? And so the seniors will start to move first. That's always the case. Not only do they start to move, and I'm an investor, I think, oh, maybe I should have a little bit of gold. I call my broker. Hey, Mr. Broker, I'd like to put 2%, 3% of my assets into gold. The broker says, yeah, why don't you buy Newmont? Why don't you buy Barrick? He doesn't say, well, let's look, let's start looking at little companies in, the Congo to see if there's any good buys, right? So they're always the first ones to move. And it's only as that sector gets overpriced and and at the same time, more retail people come into the sector, that people start moving down the food chain and looking at smaller companies. and as the bull market progresses, they look at smaller and smaller companies. The thing about the seniors, though, that's important, not only are they the first to move, but they're the more certain to move. So if you were to buy just those 5 stocks I mentioned, and I'm not recommending all 5, I don't even like all 5, but if you were to buy the 5 stocks I mentioned, which are the 2 largest royalties and the 3 largest mining companies, I can, as close to the SEC will allow me to guarantee anything, I can guarantee that if gold goes to $3,000, both 5 stocks are going to go up, right? Whereas if you buy, again, you know, Moose Pasture Consolidated and whatever I said, Amalgamated Ajax or whatever, they may or may not go up because they have much more idiosyncratic factors affecting the valuation of the stock. So the seniors are the first to move and are the more certain to move. And, sorry to add to it, and this is where the opportunity is so great, they are absolutely undervalued right now. And my friend Rick Rule has a saying, you know, don't buy hamburger when the fillet's on sale. And the fillet is on sale right now. Agnico, for example, 3rd largest mining company in the world, great company, only in safe jurisdictions, strong balance sheet, good mines, strong pipeline, etc., etc., etc. There's no particular knock that anyone has on Agnico, and yet that stock is selling at its lowest price to cash flow in its history. With gold where it is today, that simply doesn't make sense. So the stocks are very, very cheap, undervalued.
They're definitely unloved. They're definitely undervalued. There definitely is opportunity, you know, but investors do need to, you know, take the time to understand which ones could be good opportunities for them to take. Adrian, something that I want to kind of transition this conversation to is, I know I've heard you talk a little bit before about Charlie Munger, and he's had a huge impact on my investment decisions in terms of mindset. So, you know, when we think about behavior economics that we can apply to both business as well as investing, a question that I have for you is, what are 3 mental models from your toolkit that you apply to make more intelligent investment decisions?
Yeah. Well, I think the first, you mentioned Charlie Munger, and you know, one of the great lessons from Munger, I've forgotten exactly how he put it, but he said, you know, I spend most of my time figuring out how not to do something really stupid, as opposed to figuring out how to do something good. And when I think we're all in too much of a hurry, right? Particularly younger people, but everyone. And then as you older people who don't have enough money as they approach retirement, they're the worst because they think somehow magically you can have a goal. I had someone call me the other day, said, well, I've got this, you know, 401k, it's got 78,000 in. I know that's not a lot. That's all my savings. But by the time I retire in 5 years' time, I'd like to have $1 million. So, you know, you decide whether I should be aggressive or conservative. And of course, that's the wrong way to look at it. You can't look at what your goal is and just magically make it happen. So anyway, not doing something stupid, meaning not losing a lot of money on any single investment, is a critical thing for investors. And I would say particularly, and this is a sort of reverse of what the traditional financial planner will say, but particularly for younger investors, if you start putting $500, $1,000, $2,000 when you're young into really solid companies with dividends that compound and don't have a 50% or God forbid 100% loss, you're going to do so much better over 20 or 30 years than the person who's always looking for that 10-to-1 return, but along the way has 50% losses. Because when, as we all know, when you lose 50%, you have to double your money just to get back to where you were. But of course, when you're young, you're not thinking of 20 or 30 years. You're thinking of making money for the next little period. And frankly, that's one reason why I think people should put aside money in a brokerage account that they regard as it's long-term, untouchable, except in emergency, but untouchable money. It's not a way to make money over the next 6 or 9 months so that I can spend it. Because then your mindset is making that double and triple and quadruple. But if your mindset is, this is put away, I might not touch it till I retire in 40 years' time, then your mindset is making it grow much more slowly, but much more certainly. So I think not avoiding that is important. Let me think. I think perhaps one thing that's really critical is, to know yourself and to know your own risk tolerance. And I have this a lot with my clients and risk tolerance is not just your financial situation, right? That's obviously important. What's your income and what are your expenses and what are your obligations? If you've got 3 17-year-olds who are going to go to Harvard, you better have some money saved, whereas you could be in exactly the same situation without those children, where your risk tolerance can be much higher. But risk tolerance is also mental, and people don't really want to think about that. But some people, we talked about volatility earlier. If you know the sector, you understand the company, you can tolerate the volatility. But some people simply cannot look at their, whatever it is, look at their monthly statement or look at their app and see the value of their portfolio. They simply cannot deal with it going down, a stock going down 10 or 20%. And I have this with my clients. And so if someone, again, simply cannot deal with it, then obviously they need to be in much more low risk and lower volatility investments than the person who can tolerate it. So knowing your own tolerance for risk, I think, is very, very important. I would say knowing what you invest in is critical. And that sounds so obvious, but it's amazing how often many of us will go out of our circle of competence because, we're missing out on the technology boom and the AI boom, and everyone's making so much money. I don't really understand it. I don't really know about it, but hey, I'm going to buy some because everyone else is making money on it. And believe me, there's 2 things about that. One is, by the time you, who are not experienced in that sector, by the time you get around to making that investment, because everyone else is making so much money, that's probably close to a top. But the other thing that's really important about buying things that you understand is what to do when they go wrong. So I just mentioned Franco. I know Franco inside out. So when Franco dropped 30%, I knew what to do, and I was happy. My test for how well I know a company and how much I understand that investment is, am I happy when the stock price goes down? Now, to some people, that'll sound perverse. But if a stock price goes down of something that's my top quality, a top quality company that I really want to own more of, I'm delighted when it goes down in price. But if a stock goes down and my gut starts churning, this happened to me recently with Bayer. I bought Bayer, the German aspirin maker. And, they've been hit hard, but they bought Monsanto a couple of years ago, and they've been hit hard with all these judgments on the Roundup. And they were just awarded, I think it was a $14 billion judgment against them in some court in Alabama. Stock collapsed. My logic was, we all know that's going to be overturned on appeal. Those judgments always are, those huge judgments. And I just didn't know or understand the company well enough. And when it continued to go down, when you start saying, oh dear, what do I do now? What do I do now? That means you don't really understand the company well enough. When you're happy that it goes down, that means you really know what you're buying, if that makes sense. So the investing within your level of competence is critical.
Adrian, I want to ask you next, what are the most influential books that you believe hold great value for investors?
Oh, Lordy. You know, that's a good question because I'm often asked that. And, you know, the problem with most investment books is they can get out of date very, very quickly. I mean, when I wrote my book on, my last book on investing in resources, I made a conscious and determined effort, but this was not going to go out of, this was going to last. It was not going to go out of date. And, you know, things happen. I had examples in there. So you have an example, and then the company you mentioned in the example gets taken over, and everything gets out of date very quickly. Obviously, Ben Graham's book, and I would get the condensed version, Security Analysis, is a very, very good book. But even there, you have to look at the world that Ben Graham was writing in the 1920s, where he talks about nets. You just don't get a lot of those these days. Book value was much more important to Ben Graham than perhaps it is today. Certainly, you know, tech stocks and so on, you know, will trade at 10 times book value, 20 times book value, and that's doesn't necessarily mean they're overvalued. But recognizing those differences, you know, Ben Graham's book would definitely be a place to start. John Train wrote a book called Money Masters, and it's gone through several iterations, and I really can't tell you which one I think is the best. I read the first one, but and now I think it's been updated by someone else. But he looked at about 12 different investors and their styles. And the huge lesson from that book was, wow, you know, there's a lot of different ways up this mountain, because these investors all had different styles. And that is another thing that I would say is critical. You know, some people are good traders. Some people, you know, just are better at picking really good companies and staying with them. But again, it's a matter of knowing yourself, and, you know, don't try to do something that you're not good at, but stick with what you are good at. That doesn't mean you shouldn't grow, of course, and it doesn't mean you shouldn't change your mind when facts change. But if you're to give you an example, if you're a momentum investor and your way of investing is, you know, to buy things when they're moving and when the volume's picking up and the stock price is going up, and ride the momentum and get out when the momentum stops. Well, if you're a momentum investor and you buy something and then the stock price drops, don't suddenly say, oh, well, maybe I'm a value investor, a long-term value investor, and hold on to it. You know, stick with your discipline. One of the things that I will do, if I buy something for a particular, you know, there's particular reasons you're buying something, there's particular expectations, and then those expectations change. It could be the company is taken over by someone else. It could be a change in CEO who wants to go in a different direction or whatever. I find 9 times out of 10, it is better to sell the stock, sit back, and then decide whether in fact you want to buy it again as a new investment, rather than saying, well, I bought it because they were going to do X, Y, or Z, and they're not going to do X, Y, and Z because it didn't work. But he's a good guy. You know, whatever. The stock's down. That's the reason most people hold on to things, because the stock's down, which is frankly the worst possible reason to hold on to something. If what I'm saying makes sense. So sometimes I find it better when the company changes tack, just to sell it and give yourself a week or 2 or 3 to decide if you want to get back into it. It's better to make the right decision than to get the absolute low. So if it takes you a week or two to come to that right decision and you miss the first 5 or 10% of a move, that's not as important as making a right decision. So I think that's important. I think the most valuable investment books are books that teach you lessons, as opposed to, you shouldn't buy an investment book looking for what to do now. My book, for example, on investing in resources, if I may, I think the first half of the book is pretty good. It talks about, you know, what factors affect the price of gold, where demand comes from, looking, you know, it looks at price signals in different resources, how quickly they respond, etc. The second half of the book talks about different commodities, so gold, silver, copper, etc. And the second half of the book is not only out of date, but I don't think it's as valuable to people as the first half, which gives you the framework and the lessons.
So, Adrian, what do you believe makes a great investor?
Let's see, good question. I think, first of all, to know yourself, to know what you're good at, to know what you're not good at, and that also includes knowing your circle of competence as well. That's critical. Definitely discipline is the most important thing. Discipline. You've got to have discipline in buying and discipline in selling. I can't tell you how difficult it is when you spend a lot of time researching a company. Maybe I meet the person at the CEO at a conference, I research, I call associates. I don't want to keep going about resources because that's not all we do, but let's say it's a resource, it's an exploration company in Nevada. I call people I know who've worked in Nevada, you know, I call geology friends, and I say, wow, I really want to buy this. And by that time, the stock has doubled and it's no longer cheap. That it's a very difficult decision for anyone after you've done all the work and made the mental commitment to buy something, not to buy it simply because the timing is not right. So discipline is critical. Discipline in buying, discipline in holding, and obviously discipline in selling. Those things are all very important. That involves patience. You know, and again, all stocks are different. If you're looking at Nestle, you're not looking at a particular event. If you're looking at Ajax Exploration, which is just acquired a property and it's starting to drill, you know, in that circumstance, patience is very important because things always take longer to happen than you think they're going to happen. Things always go wrong. So patience is critical. So long as your fundamental thesis remains true, remains on track, then patience is very important. I would say those, know yourself, discipline, patience. I would think those are the most critical. What is your definition of greatness? I think if we're talking about people, it's someone who is living the life that they want to live and achieving the things that they want to achieve. Now, obviously, greatness involves doing things that help other people. And I don't necessarily mean, you know, in a totally altruistic sense, because, you know, someone like Steve Jobs, I don't think he set out in business saying, I'm going to help people. But what he invented, developed, did help a lot of people. So, you know, living on a desert island by yourself and doing 100 push-ups in 5 minutes, that might be your goal, but that's not really greatness because it doesn't help anyone else. Beautiful definition. Now that you have a good feel for my show and what it's all about, who is a future guest, someone that you know personally that you would like to see on this show? Oh, wow. Well, I think you've had Lobo Tigre, have you? Yeah. Do you know Brent Johnson, the dollar milkshake guy? He'd be very good. He's a very good guy. Have you had Rick Roll?
Yep.
An interesting guest might be Albert Liu. Do you know Albert Liu, who runs Rick Rules? He did run the conference for Rick for a few years, and now he runs the online platform called Rule Classroom. And he's a very, very interesting guy. I think you'd find him a very good guest.
I appreciate those list of names. What is one question that you've always wanted to be asked before that you've never been asked?
Well, the question I'm never asked is, do you enjoy what you're doing? And maybe it's obvious that I do enjoy it, so people don't bother asking it. But I think that's a critical thing. If you're hiring anyone, a doctor, a car mechanic, a money manager, it's important that people actually enjoy what they're doing. Because if you enjoy what you're doing, you're more likely to spend time researching and developing your skills, but you're also more likely to do a good job, frankly.
I agree with you on that. I think people that are passionate about what they're doing, they're usually then disciplined. And if they're disciplined, they're usually dedicated to their craft, right? So
Sure.
I really appreciate that answer there. Before we sign off, where's the best place for my listeners to connect with your work online?
Yeah, adrianday.com is the best place, and then they can go from there. Obviously, we got an email address, telephone, but if you start with the website.
Adrian, I want to take this last little moment again to thank you for your time. Thank you for being here today.
Well, thank you very much for having me. I enjoyed this.